The majority of people have the best chance of becoming wealthy by making wise investments over time and letting compound interest do the bulk of the work. Even though the strategy is straightforward, it is by no means simple, especially if you make crucial investing mistakes that not only frustrate you but also eliminate any chance you have experiencing significant investing success. Fortunately, I'll reveal to you in this video the biggest investing mistake you can make and how to avoid it. But before we get deeper, if you're new to this channel, hit the subscribe button and the notification bell so you don't miss any of our videos. So without further ado, let's get started. Many people think that to succeed in investing, you need to have access to insider information or be lucky and buy a stock that suddenly soars in value. While these two distinct events can increase your wealth in the short term, there is one aspect of investing that you should be aware of and use. Most people believe that if you want to use investing to increase your wealth, you must be an expert at stock analysis or have connections to people who are. However, your behavior, not your technical skills, is the most important factor in your ability to succeed in the stock market. A 2018 study found that investors who used a behavior-modified approach to investing saw returns up to 23% higher over 10 years. The study was published in the Journal of Financial Planning. The difference between retiring at age 55 and age 70 could be that 23% return. Understanding and exercising control over your emotions is the key to obtaining these higher returns. And in this video, I will go over 3 emotions that you need to control to achieve investing success and strategies to do just that. Number 1. Fear. There is no denying the sentimental value we place on our money, and fear comes into play when we put this money at risk, which is always the case when investing. Unfortunately, this fear can negatively affect our ability to successfully invest. Consider an analysis from 2018 which found that the average investor lost more than double that at 9.42%, when the S&P 500 lost only 4.38%. They lost money as a result of their hasty sales during a market decline. Look at the best buying opportunity in recent memory on March 1, 2009 as another example. Investors had a fantastic opportunity to purchase shares of well-known companies for pennies on the dollar during that trough. Bank of America, General Electric, and Wells Fargo were just a few of the companies whose stock prices were in the single digits. Many of these businesses later experienced growth of 500% or more over the ensuing years. However, fear drove a lot of middle-class employees completely out of stocks. Nearly 2/3 of Americans, or 63%, own stocks in some capacity, including through employer-sponsored plans like 401ks or simple IRAs in the mid-2000s. Following the Great Recession, that proportion fell to about half of Americans. The longest bull market in history, which lasted from 2009 to 2020, was missed by those who stayed away from the stocks. They allowed their fear to prevent them from accumulating wealth. The wealthy, however, kept investing in the stock market. The wealthy have a different perspective on money, and they don't sell everything they own in an instant out of fear. Therefore, fear can prevent you from making long-term gains, in addition to forcing you to sell at a discount. Number 2. Greed. The buying side of the equation follows the same reasoning. Too many would-be investors avoid participating in market upturns in the beginning out of fear, but as the stock market rises, they start to see dollar signs. They suddenly see those gains and want in on them after waiting for a track record of growth before they feel comfortable investing. But much of the bull market may already have ended by the time they see enough expansion to turn envious and greedy. The initial weeks and months of recovery frequently turn out to be the best. It increased 15.1% in the first month following the S&P 500 low in October 2002. After reaching a low in March 2009, the S&P 500 increased 26.6%. Investors who waited for the greed to propel them into the market over the following month lost out on a large portion of the recovery. The typical investor underperforms the market both in favorable and unfavorable markets. The S&P 500 generated an annualized return of 985% between 1996 and 2015, a period of 20 years. However, research revealed that a typical investor only made about 50% of that 5.0%. Being in control of your emotions is crucial when attempting to increase your market. Number 3. Impatience. Have you ever sold an investment because you were dissatisfied with it after learning about its performance only to watch it soar later? Fundamentally sound investments can be dumped out of anger and frustration if you get tired of waiting for them to make progress. However, overreacting to impatience and frustration frequently prevents you from making the best decisions and ideas. True, occasionally new information surfaces that alter your initial hypothesis. Keeping an open mind and avoid holding onto bad investments with obstinacy. However, if an investment's fundamentals continue to be strong, don't sell it off just because other investors haven't yet noticed it. When investing in a company, keep your cool. Your investment should remain consistent with your underlying thesis as long as it hasn't changed. You may be thinking that it's difficult to control these kinds of emotions, especially when thousands of dollars are at stake. In all honesty, I concur. In my investing journey, I have given in to each of these emotions, and it wasn't until I discovered coping mechanisms for these feelings that I began to notice real advancements in my portfolio. Here are 5 strategies that ensure I stay composed when embarking on my investing journey. Strategy number 1. Using dollar cost averaging. Smart people adore chances to demonstrate their intelligence. Sadly, that necessitates trying to time the market when it comes to investing. From personal experience, I can tell you that it is ineffective because no financial model can accurately predict humans' irrational behavior. Nobody can ever truly predict which way the market will move at any given time. Furthermore, the highs and lows of tomorrow might still be less desirable than the prices of today. Market timers frequently find themselves waiting for a fictitious better time that never materializes. Instead, make the same amount of investments over the same period in the same investments. Dollar cost averaging is the term for it, both boring and effective. Strategy number 2. Automate your investments. Using robo-advisors is another way to take emotion out of investing. Robo-advisors have advantages and disadvantages, just like human investment advisors, but they excel at several tasks, such as suggesting investments and automating them for you following your objectives, risk tolerance, and personal information. The investments suggested by robo-advisors are suitable for people just like you. They will then take care of purchasing, managing, and rebalancing your investments for you from that point on. You can then set up automated recurring transactions to your robo-advisor account. Less emotional involvement translates to better chances of success in your investing endeavors. Strategy number 3. Diversify your portfolio. Diversify your investments across numerous asset classes and various assets within each asset class in the stock market. This entails purchasing tens of thousands of unique stocks across numerous continents and regions in various industries with various market caps. Index funds make it easy and affordable to accomplish. Real estate appeals to me as well, especially for the quick passive income and tax benefits. As you near retirement, your ideal asset allocation changes. Your asset allocation is defined by what you aim to invest in each asset class. As some of your investments perform better than others, your asset allocation also drifts. That means you require a method of rebalancing your portfolio, which will allow you to return to your desired asset allocation. Strategy number 4. Automatically rebalances your portfolio. There will always be a need to manage your assets due to the volatility of all financial instruments, and rebalancing is one way to do this. Consider, for instance, that over the next 6 months, you allocate 80% of your portfolio to stocks and 20% to bonds. You must sell some of your stocks and use the proceeds to purchase more bonds to get your portfolio back to the desired asset mix. Of course, you can do this manually, but you can also delegate the task to a robo-advisor or a real investment advisor. Balance restoration aids in ensuring that your portfolio meets your individual needs, and it also increases returns and takes the emotion out of investing. Strategy number 5. Protect your retirement. Market downturns do not affect your daily life while you are working a full-time job and investing frequently. They assist you. They offer a chance to acquire assets while they are on sale. You get to buy bargains and you don't have to sell any assets to weather the downturn. That luxury is not available to retirees. To cover their monthly expenses, the majority of retirees must gradually sell off assets from their nest eggs. The plan is for them to gradually withdraw from their retirement savings without running out of money before they pass away. In retirement planning, the rate at which you can draw down your assets is referred to as a safe withdrawal rate. During market downturns, retirees' assets suddenly lose a significant amount of value. If you are planning to withdraw 4% of your $1 million nest egg annually, or $40,000, you would only have $700,000. Retirement investors face a particular issue known as the sequence of returns risk. When markets crash just before retirement, it turns out that the market crash that occurs early in retirement does much more harm than a similar crash that occurs later in retirement. The more time you give your portfolio to grow in a bull market after retiring, the more margin and loss protection it will accumulate. As they near retirement, older adults need to take extra care to avoid investing emotionally. If they become alarmed and invest all of their money in bonds, they may not receive enough returns to maintain their nest egg over the long term. On the other hand, they become vulnerable to a stock market crash if they become overly greedy and invest all of their money in stocks. Depending on your risk tolerance, subtract your age from either 100, 110, or 120. The resulting percentage is the portion of your portfolio that you ought to keep in stocks. Subtract your age from 110 if you are 60. This means that stocks should make up 50% of your portfolio. You will be able to write off downturns even during your lifetime as long as you can keep your emotions under control and believe in the market's historical trends. Well, there you have it, guys. Thanks for watching. If you're new to this channel, make sure to subscribe and hit the notification bell button to get updated on our latest videos. Don't forget to like this video and drop a comment. See you next time.